Good afternoon. Welcome to the TheoTRADE afternoon video. I am Blake Young. Today is December 7th, 2023. And today we're going to talk about the rise and fall of the Nasdaq, what every trader should know. Clearly the Nasdaq has been all over the board. This is the Nasdaq future contract for December, showing you really the strongest moves in the last 6 months, being a widening pattern. We've traded all the way down to from the highs to the lows in about 3 months and recovered that to retest the highs in just over 5 weeks. So these massive swings, it should be the rise and fall and rise again of the Nasdaq, and what we should know. What is driving this? We can talk and we can speculate and we can guess and we can assume all sorts of things, but in the end we want to look at the math. We want to look at the data of what's really driving it. If you're a US dominated account, half of every one of your trades is the US dollar. So when we look at this, if we consider the US dollar is what is driving here, we say that it's the Nasdaq quoted in US dollars. So half this chart is whether the strength of the US dollar is getting stronger or weaker. When the US dollar is getting weaker, half of the movement's the Nasdaq, half of the movement is the US dollar. Arguably, it's in essence a pairs trade. So as we're looking at this, let's look at the correlation, the math behind it. And to do that, let's go in to the correlation study. So we go up to the top, we click on studies, go to edit studies, and we go to correlations. So we go into correlations and we look at the moves here. And we're going to compare the correlations in the Nasdaq to the US dollar. We're going to compare the correlation of the Nasdaq to borrowing rates, because technology companies also have a tendency to borrow quite a bit to do their research and development and to grow their companies. So we'll start with the dollar index and we'll look at that component first. I'm going to click on apply, and what we want to do is we want to look at the math around this as a 1 to -1. The most correlated it can get is perfect correlation, meaning it's the exact same instrument. Maybe think of this like a comparison between QQQ and the Nasdaq would have a correlation near 1 because there's 100% movement together. Well, this is an inverse correlated movement with the US dollar. So as we're looking at the US dollar, what percentage of the last 6 months has this been below zero and inverse, meaning if the dollar is gaining, the Nasdaq is weakening, or if the dollar is losing, the Nasdaq is gaining. And just over the last 6 month time period, you can see that is a highly inverse correlation. And currently, even with today's move, the very large bullish candle that we had today, pushing prices back up to retest the resistance, the correlation with the US dollar is 84%. So the correlation says if the dollar is weakening, then you're going to get an 84% reciprocal behavior in the Nasdaq, or 84% of the time. The correlation is about 84%. And so if you're familiar with beta weighting is a similar kind of approach to correlation, but we're simply saying that the US dollar is about 84% inversely correlated to the Nasdaq. Now, that move, even with this big move and the move that we're seeing today, is still holding up very, very high. So much of the action that we're seeing in the Nasdaq is driven by the US dollar. That works on the intraday as well. So if we go to 5-day 15 minutes and we look at the correlation here, again, we want to zoom into the 1 and -1 so that we're looking at the right ratios. And you're going to see that much of the trading day, ignoring the overnight, much of the trading day is highly correlated as well. We can go in here and turn off the overnight and not look at the extended hours and just look at the regular trading hours, and now you can see that the majority of the time we have a very, very high correlation. Here at the end of the trading day, you can see it's very, very flat with the Nasdaq, and so we've decoupled. That would probably tell us that the US dollar is moving and the Nasdaq is not in these last few hours. But overall, you can see even on the intraday, at least over the last 5 days, and we could do the same thing for 10 days and further back, we have a pretty high inverse correlation to the US dollar even on the intraday charts. Let's do the same thing now with borrowing rates. Assuming that the big tech companies borrow to be able to get their AI developed, which we'll talk about here in a minute, then we're going to go in and compare what about borrowing rates. Now, what drives borrowing rates? Borrowing rates are driven by bonds, and bond prices are inverse to bond yields. So let's start with the bond prices and say we should therefore expect bond prices to rise and fall in conjunction with the rise and fall of the Nasdaq. So we're going to look for a positive correlation between the Nasdaq and the 10-year Treasury yield. Generally speaking, business loans are made on a 7 or 10-year bond issue, and so we would look at corporate loans and private loans and mortgage loans, all based on 7 and 10-year yields. So if the 10-year Treasury bond is going up, then the yield is going down. If the yield is going down, cost to borrow is getting less, and therefore these tech companies can grow faster and faster. Well, as you can see here, going back, not as high of correlation that we saw on the US dollar, or inverse correlation, but still a pretty good correlation. We've just decoupled from it from the last couple of days. So as we're looking here again, we can see that when the bonds are rising, the Nasdaq rises, which would argue that when bond yields are falling, the Nasdaq rises. And so that correlation, again, over the last 6 months has been very strong. We've seen it get to 80, 90 plus percent, 96 percentile of being highly correlated. Currently, though, we're not correlated. But if we look back historically and look to when those correlations went inverse, and specifically I like to see more than 50% correlation. If we see the inverse correlation to the tune of 50% or more, there's something broken in that move. We could call it a divergence of intermarket correlation. And so as we're looking at this move past -5, generally speaking, that tells you look for a sudden move and a breakout that's going to get it back into correlation. So either we're going to expect the Nasdaq to snap back in line with bond prices, inverse to bond yields, or we're going to expect bond prices to snap back and mirror what the Nasdaq's been doing. So this little recovery over the last 4 days, as we've gone highly negative, that's going to set us up for the idea that we're probably either going to see bond prices jump and yields fall again, or we're going to see bond prices stay where they're at and the Nasdaq drop really quickly here. And we can go back historically and say, when did that happen? That was a pivot point. When did this happen? That was a little weaker, but still a lower high. That was a pullback of 3.5%. This was a pullback of 6.5%. And even as it dipped back down, it called the bottom before it turned back up. So the decoupling, the correlation, when it is disrupted from what it normally is also an indication that you can expect or maybe should be looking for a corrective move to get you back in line with historic correlations. And to prove the inverse of this, we'll take the yields instead of the 10-year Treasury prices. Let's go into the yields and just show that it is really about the borrowing cost. We'll change this over to the TNX 10-year Treasury yields, and you'll see that the prices of the Nasdaq have a tendency to move opposite of yields themselves. And currently we're decoupled. So if we go look at the yields, we'll just use the 10-year Treasury yield really quickly. 10-year Treasury yield in the last 6 months has been sliding over the last, well, since October. Lower highs, lower highs, lower highs, lower highs, and we're pushing down to test the lows and test back to August lows, testing August lows. And so as long as the yields are continuing to hold down, then we would expect the Nasdaq to remain high. Now this should have a similar or direct correlation to those companies that are top users of AI. And we're going to look at some of the ones that we expect as well as some of the other ones we might not expect. So we can start with, say, Microsoft. Microsoft has a lot of movement in AI, and you can see that we're pushing up near these highs. The correlation or inverse correlation with bond yield is not there, and so we see some speculation pushing Microsoft to a new yearly high and a long-term high with the expectation of AI lifting Microsoft. We went from 309 up to 384, looking at about a 20% increase plus in the last 3 months. And of course, we know NVIDIA is a highly connected to AI, and we can see that the prices have decoupled through here as well versus bond yields. And we expect those to be inversely correlated as well. Now, NVIDIA is kind of an interesting one because we need yields to be lower, not just because NVIDIA will have its own growth, but the companies that are buying NVIDIA chips will have or be looking to borrow money to continue to expand in the AI world. So NVIDIA is not reaching new highs, and I want to be able to look for opportunities to short and sell NVIDIA near 480 as it is struggling to move up here, and it looks like we're not retesting the highs. So the decoupling is probably that NVIDIA is not doing as well as it should. So what's going to happen if yields bounce off of this 3-4 month support level? Then NVIDIA will likely sell off and drop from 480 back to 420, if not back to 400. We take a look at IBM. IBM is a company that has kind of been forgotten. Big user of AI, and they're treated for the most part as just a juggernaut, a colossal old company that just does what it does and kind of plods along. But as you can see, IBM, from the year's lows to just what we hit just this last week, increased by about $33. And we're talking about 20-25% increased value. And it's being driven arguably by lower borrowing costs and AI as well. In fact, the correlation has maintained despite what we've seen in some of the other stocks. They've maintained that as long as the interest rates remain low, IBM is climbing. And so we've actually maintained a 77% inverse correlation to interest rates. Today, the big news was surrounding Google, or Alphabet, and Google gapped from 130 up to 136 and tested 140. Retesting these previous highs, and I was looking at this as a potential breakout as far as a price pattern, creating these higher lows or a cup and handle type pattern. And as we're looking at this retest of 140, we're still decoupled here, and this is primarily news driven. Today, Google announced that they had their new AI model called Gemini, obviously to compete against GPT-4 and OpenAI. So as we're looking at this move, this is a very strong move, and it could turn into a cup and handle. So if we see yields stay low, if we see Gemini prove to be a major contender, then I think this looks like we're going to create a cup and handle type pattern. For those of you that are maybe not familiar with a cup and handle would look something like this, where this would be the cup, this would be the handle. It'd be an ascending triangle. You could also look at it that way. Either way, we're looking for a move of about 125 to 140. And if we clear that 140, we're looking for an additional 15-point move higher. And we're looking at new record highs of 165 for Alphabet. Some other ones we might look at just as some hidden gems or some hidden ones that follow AI. CRM, they obviously had better than expected earnings that caused that gap up, but CRM has a lot of weight into AI, or at least AI focus. Obviously you have things like Tesla, and watching Tesla, here's one that has not moved, so this could be another opportunity to short Tesla if yields go higher. And that's what I'm looking for, is a short off of this trend high, trend high, trend high, trend high. And if we reject 245 and yields bounce up, I expect Tesla to fall back down to about 200. Amazon didn't seem to get a reaction from the AI news. Obviously very heavy weighted into AI with Amazon Web Services. And as we're holding up near these highs, it's a, I guess, pot odds for AI and Amazon to move higher or lower. But maybe one of the ones that we might look at for an opportunity is something like Baidu. And Baidu, who has not gained like the rest. If yields stay low or continue lower, then you might see some upside to Baidu pushing back to 122 and 134. And one that I would maybe look for fading is Meta, because Meta has pulled back similar to NVIDIA. So if we see anything that creates a lower high and a bounce up in yields, then I'm looking for a short in Meta. So really what I'm doing is I'm looking for the opportunity of saying, okay, if yields are going to continue to slide, which ones are the best opportunities? The ones that are already moving, the ones that are breaking out, the ones that are consistently winning on the AI front. If yields bounce and go up, which ones didn't benefit? Because those are the ones that are probably giving us the better opportunity to go lower. And so as we're looking at the rise and fall of the Nasdaq, we need to remember that's the rise and fall of those things underlying. And it all comes down to those three things currently: the dollar, yields, and then speculation of AI. So play all of those. Play the strongest with the strongest if yields continue to fall. Play the weak and rolling over at highs if yields bounce and go higher. And play those that have been oversold that are bouncing up if yields continue to slide lower as well. So it gives us an opportunity to be able to trade specifically the best with the best as it climbs, and fade the strugglers in the AI and the Nasdaq if yields bounce and go back up. Well, that's going to do it for me today. Thanks for watching. We'll look forward to talking to you again